EIP 1559 gets in place, now that it looks like it's going to move forward, there is an opportunity out there with a lot of the way that arbitrage works with DeFi to not necessarily get all of the transactions fees burned. And we've asked Micah to come on and help us give us an overview, not just from talking about it, but actually sharing the screen and showing some detail when it comes to the architecture, and really answer some questions or help us get to a place of asking questions that we can then point back to somebody like the pools, if we're talking Flex Pool or Ethermine, any of the other pools out there, of how they can help get their system set up and configured for the folks that are contributing hash power to those different pools, and we can maximize the opportunity there. I think it'll also mitigate some risk here that I've been presenting when it comes to where hash power will go if the cut is too deep on the Ethereum network post EIP 1559, and hopefully we can get some of those questions answered for everybody. So we're gonna turn the floor over. We got a few other channels broadcasting right now. I know Nemesis has got his up.
Crypto,
I think
and Hot Rods.
Yep, got his going, and mineyour.biz got his. Yep, DCA is going. So you guys can watch them on any of the channels there too. And we're going to really turn the floor over. The way this is going to work is just kind of set up the scenario of what it is, and Mike, I'll go into a lot of it. So it's going to be a lot of us listening, and then we'll have a part of this where we can go and ask some questions, and we'll open the floor up then. So everybody else stay muted and allow Micah to kind of introduce the process, and we'll see what we can learn with this.
Guys, go ahead and submit your questions in our chat here live so I can bring them up later on.
So feel free, if something I say doesn't make sense, go ahead and interrupt me and just say, I don't get it. My goal here is to hopefully educate as much as possible on how these things work. And the reason I wanted to do this is because the other day during the community call, I realized, and I didn't realize this previously, that I think a lot of miners don't fully understand like what's happening in the blocks that they're mining. Like you guys mine a block, and you've got your rig set up, and you're doing you guys are experts at the hardware side. But what goes into that block is kind of something that's just it's stuff, a bunch of bytes, right? And so I think it is very important, I think, for miners to understand what's going into the blocks, particularly on Ethereum, because there is so much opportunity when you're in a position of miner. And that's what I'd like to go into, at least at first. So the MEV, miner extracted value, is what it stands for. A good short way to define what it means is it represents the total value that can be extracted from the reordering, censorship, or insertion of transactions within a block. So when you mine a block, you have a bunch of transactions that are included in that block. And the miner gets to decide, A, which transactions are included, B, what order they occur in, and C, if they want to add anything else along with what's in the pending pool. This gives you a lot of power. I don't know if you guys know anything about high-frequency trading, but in high-frequency trading and like stock markets and whatnot, you have these people that basically pay huge amounts of money to sit very, very close to the exchanges. So they will run a computer that's half a millisecond away from an exchange. And the reason they do that is because there's a lot of opportunity for being first, for being the person who can do the thing the fastest. There's huge opportunity. And so miners, you guys basically are that exchange. So you're not just close to the exchange, you literally are it, or the mining pool, I should say. Whoever's constructing the block, whoever's deciding what transactions go in, you guys are the person who can react fastest, and you have 100% control. And so that gives you a huge amount of power when it comes to these arbitrage scenarios. So let me draw something for you guys here. So normally the way Ethereum works, and I'll just give a fairly high overview. Let me know if you guys want more details on this, but you've got a bunch of people, and we'll just say these are individual users over here. This should be like a user. And what they do is they send transactions to an Ethereum node. So this is Ethereum. Oh, sorry, my pen's not working great. So there's an Ethereum node, like Nethermind or Besu or Geth or Open Ethereum or whatever. This is might be Infura, so it might be something that's run by a provider that they're talking to. So they're just sending it over the internet. Might be something that's running locally on their machine, whatever. And they send a transaction to this person. And then that transaction gets gossiped out. So there's a bunch of these Ethereum nodes out there on the internet, about 10,000 we estimate. We don't know for sure because of the way gossip networks work, but this one tells its friends and this guy tells its friends. And this is how gossip networks work, basically, is you're not connected to everybody, you're just connected to one, and that guy's connected to maybe a dozen or 50, and that guy's connected to 50 more. And so the transaction spreads out. Each of these nodes will keep track of a list of all the transactions that it has seen. And there's upper limits on this, but we don't have to get into that. And so they all have this list, and that's called the pending pool. And so this is the pending pool. So these transactions are going to these nodes, and they're being gossiped out to the network. And we call this the global pending pool specifically because all the nodes in the network basically have the same set of transactions in them. One of these nodes will be a miner. So you have some guy sitting here, and he's connected to everybody else, and he's a miner, right? So our mining pool specifically, if you're talking about from your guys' point of view, from the network's point of view, we only see this guy. We don't actually see all the hash power behind it. We just see this one node. And so he also has a pending pool. So the transactions eventually make it to him. And then he'll create a block. And so he takes those transactions, puts them in the order that he thinks makes the most sense. And then that miner will then send that block out to all its peers. And then it will basically follow, this path backwards and eventually get to the user. And the user will then receive that block. So that's a very high level overview of how transactions work in Ethereum. What matters here is, again, this order. So these nodes have a bunch of transactions, but the miner is the one that gets to decide which ones are included and in what order they're included. So he's the only one that actually matters. So you don't actually need to send your transaction to all the other people. You only need to send it to the miner directly, because he's the one that's going to decide what goes into the block. No one else needs to see it until the miner makes a block. And so what you can do is, as a miner, and let me get a new screen here, figure out how to scroll on the two. There you go. So in a block, you have a list of transactions. And so we have TX1 and then TX2, etc. Sometimes normally when a miner or a pool or whatever sorts these transactions, they sort them by highest gas price, because that's a very simple way to ensure that you'll probably get quite a bit of money out of the block. Like, you don't want to put the really cheap ones in first and then not have room for your big ones. So you put the big ones in first, the ones that have a high gas price, because that'll increase the chances that you can get more gas money out of it. But you can also make money as a miner by choosing what does or does not go in. So if you imagine, this is a transaction here, and I don't know if you guys are familiar with Uniswap. It's a just trading app that runs on Ethereum, and so you can swap one coin for another. So when someone does a really big swap, like they're swapping, let's say, ETH to USDC, right? And they're some big whale, and they do a swap, and they do a huge swap, and it moves the market. So what you can do is, normally it's maybe they put a high gas price in, so they come first in a block. As a miner, you can say, oh, that's a huge transaction. I want to put something in front of it. So I'm going to put a new transaction into the block up here in front. We'll call it TX0. That will shift the Uniswap market before this big trade goes in. And then after the trade goes in, I also want another transaction to run immediately after. It moves the market back. And what this does is it makes it so you actually make a bunch of money off this big whale. So the big whale basically is coming in and they're saying, I'm going to trade 1 million ETH for USDC or whatever. And right before that, you come in and say, oh, well, I'm going to take out a flash loan. A flash loan is basically where you borrow money for a very, very short period of time. Actually, flash loan won't work, so ignore that. Basically, you just you come in and you move the market ahead of them. They then make their big trade, and then you move the market back. And so you would actually make money off of this. Trying to think if it's worth going into the details of the mechanics of exactly how that works in trading. Let me know if you guys care about exactly why that works. But the point here is that by having a transaction before and after this really big whale makes a trade, you can make a huge amount of money. Another common form of MEV is censorship. And so this was a little more tricky to exploit, but in theory, if there is a transaction that's going to go in, and there may be value in not having it go in. For example, there's in compound stuff, they have these things called Oracle updates. And so you might want the Oracle update to be delayed by a block. And as a miner, if you mine that block, you can decide, does this Oracle update go in this block or does it go in next block? And there may be opportunities for you or for someone who you're working with to make money based on when that transaction occurs. And you can't censor it 100%, like you can't decide this transaction will never go through, but you can decide whether it goes through in your block. And so if you have like a bunch of miners and they're all censoring, you can push a particular transaction out quite a bit until some miner that's not censoring it lets it through. The other thing you can do is we can do reordering. And so reordering is particularly interesting because you have these, they call them Oracle updates. And so what happens is something happens on the chain that is very interesting. And these are, when you guys see these really, really big blocks that have huge amounts of ETH in them, they're usually Oracle updates during like an ETH crash, an ETH price crash. Oracle updates result in liquidation. So it's basically off-chain, like someone goes to Coinbase or whatever and looks to see what's the price of ETH and USD, and then it's dropped. And so the Oracle updates. When the Oracle updates, a bunch of people get liquidated. So basically they get margin called, and they have a bunch of like really high leverage positions that are going to be closed out. And the people who close them out make a percentage off of what is being closed out. So you have $10 million worth of leverage being closed out, and you get 1% of that. That's a good money. That's $100,000 that you get by closing out those positions. And so this is why you see currently this happens to be a gas price options. And so what happens is someone sees the Oracle update come in, and so we have do another screen here. So someone sees the Oracle update come in to the pending pool that we talked about earlier. So this is the Oracle update. So this shows up, and this is a transaction. And this shows up in the global pending pool. So everybody sees it because it goes through the Costas network. Like, so everybody on the network sees this at about the same time, and not exactly the same time. If you happen to be closer to, like physically closer to where this is sourced from, you might see it sooner. But generally, everybody sees the Oracle update around the same time. And then you have all these bots out there. So you have bot Alice and bot Bob and bot Carol. And they're all waiting to see this. Like they're just looking at the pending pool, watching for this Oracle update, because they know when that Oracle update shows up, there's a lot of money to be made. And so what they do is, as soon as they see the Oracle update show up in the pending pool, they immediately send transactions to the pending pool themselves that try to execute immediately after the Oracle update. So if the Oracle update had a 100 GWA gas price, all these guys would send transactions with like 99.9999 GWA gas prices. And the reason is because they want to be right after the Oracle update. They do not want to be at the same time as the Oracle update, or don't want to be before, they want to be right after. And so they all spam this transaction, these transactions, and they all are for 99.99999 GWA. The reason they're doing this is because, again, whoever comes immediately after this Oracle update can make a huge amount of money on liquidations. And so, and again, when I say huge amount of money, I'm talking in a big ETH price crash, those liquidations can be worth millions of dollars. Like, this is a lot of money that we're talking about here. And so these people will pay a huge amount of money to be the one that gets to liquidate. And so they all throw their transactions out. And then one of them will get lucky enough to be the one that shows up right after the Oracle update. And so maybe Oracle update shows up here. So the Oracle update will show up like here in the list. And then Bob will show up right here. And then Carol, my writing's not great here. And so in this case, Bob is the one who gets to do liquidations, and Bob gets all the money. So there's another form, and so in this particular case, this one's particularly interesting because miners don't actually make much from this one. So this is one of the types of MEV that miners currently could make a huge amount of money on, and they don't. And the reason for this is because the Oracle update is at 100 GWay, Bob, Carol, and Alice, who are all competing to go right after the Oracle update, Bob, Carol, and Alice would be willing to spend like 100 grand to get immediately after the Oracle update. But because of the way transaction sorting works, they need to spend 99.9999 GWay, which, maybe is for a big transaction, that might get the miner, I don't know, like a quarter of an ETH or something like that. And so even though they're willing to spend a whole bunch of money, due to the way miners sort transactions, they don't end up paying very much. They end up competing just on who's first to the miner. If, on the other hand, you had a miner that was collaborating with Bob, Carol, and Alice, the miner could say, hey, whichever of you pays me the most, I will guarantee that you show up right after the Oracle. And on top of that, as a miner, I will guarantee that if I mine this block with the Oracle update in it, if you're not immediately after the Oracle, you don't have to pay me anything. So you basically create an arrangement with these backrunners. These are called backrunners. They're running immediately. They're trying to be after something, so you call them backrunner. You're trying to be in the front, you call them front runner. And so these backrunners would be willing to pay a bunch of money, and we just need the mechanism for them to be able to pay the miners, to be able to pay miners a huge amount of money so they can be second. And on top of that, if the miner can give them an additional guarantee that, hey, if you're not immediately after, so Carol, she's screwed here. She did not come right after the Oracle update. So Bob took all the money, but she still has to pay for gas. So she still paid that 100 GWay gas price to get nothing. So Carol would rather just not be included at all. And so the miners and these backrunners can make an agreement where the Oracle goes, they guarantee the backrunners that, hey, if I mine this block, whichever of you gives me the most money, I will guarantee that you show up right after the Oracle. And if you don't show up right after the Oracle because someone else paid more money, I will not include you, so you won't pay anything. And this is a great deal for these guys because they can now bid and they don't have to just worry about chance on getting in. So they can bid for a position. And it's great for the miner because the miner is now getting a big chunk of money from these guys. So they're basically auctioning amongst each other. There's another type of Oracle update, just since we're on the topic of Oracle updates. It's very similar to this one, except for the Oracle update. The way it comes in is anyone can take it at any gas price, and those do result in gas price auctions. And so in that case, the Oracle update goes out, and I don't want to get into the details unless you guys want, but it goes out as a signed message, basically. And then anyone can bring that message to the chain. And so Bob, Carol, and Alice can actually bring it with them. And so they can then do a gas price auction, a traditional one, where they just basically bid against each other to get first position in the block. And so the miners do actually make quite a bit of money in this one. This type of Oracle update is generally the ones that you see when you see this like abnormally large block, and they happen like maybe once, especially during ETH crashes. You'll see very big Oracle updates, very big blocks in terms of gas earning. And those are usually caused because of this. So it's interesting here for miners specifically. And kind of you guys, this is where you guys need to be watching your pools very closely, is that for the second kind, where it's a gas price auction, it's very obvious that the miner of that block got paid a bunch of money because the gas price shows up on chain. If your pool is coordinating with these people to do this kind of Oracle update, so this one on the left here, the money that goes to the pool is not immediately obvious in the gas price. So the gas price, again, for the Oracle is 100, and the gas price for Bob here is 99.999 or whatever. And this is all you see. And so you look at this and you're like, okay, so as the miner of the block, they got 100 GWay for that transaction, 99.99 GWay for that transaction. Maybe there's a quarter of an ETH in this whole block or whatever. In reality, though, Bob may have paid, if the pool operator was doing this thing I talked about earlier, where they're coordinating with these people, Bob may have paid via another channel the pool operator $100,000, but it doesn't show up in the gas price list. So this is where it gets tricky as an individual miner participant in a pool to figure out ways you can identify when your pool did one of these side channel payments. They usually do show up in the block, but they don't show up in the gas price. And the way they show up in a block, just to go over this, I suspect you guys will care about this part. So what actually happens is the Oracle update comes in, and then you'll see Bob's transaction where he does liquidation. So Bob, liquidate. And then you'll see another transaction after that where Bob sends to the Coinbase of the block. So whoever mined this block, Bob will send money after, like in a separate transaction, he'll send a big amount of money into the Coinbase for this block. So one of the things you can do to detect this type of thing is keep an eye on the pool's Coinbase. So when your pool mines a block, look to see if its balance went up more than the total amount of gas that was spent, or of money that was spent on gas. So the amount of money spent on gas was 0.25 ETH in this block. But the author of this block, so the Ethereum account that mined this block, their balance went up by 100.25. That means they got a 2 ETH block reward, 0.25 for this is the block reward, right? So they got 2 ETH for the block reward, 0.25 for the transactions themselves, the gas on the transactions, and then they got 98 ETH from somewhere else. And that's very suspicious. Like Coinbases generally don't get money from anything other than mining blocks. Like money is not, they're not like buying ETH off of Binance and sending it to the Coinbase for a block. Like they're getting it from somewhere. And so if your pool suddenly gets 98 ETH out of nowhere, there's a good chance that it's because they included one of these transactions, or there's groups of transactions, and they were paid via secondary channel. So again, keep an eye out for that as individual pool miners to make sure your pool is not screwing you over. It's a very common way to pay. That being said, you have to be you still have to be careful because there are other ways that you can pay out of band. It's just this is the most common one. So currently, the most common way to pay a miner, other than via gas prices, is via this Coinbase. I want to take a brief break here. Get some quick questions just to make sure everybody's following and not going too crazy and losing everybody.
No, that's good. And hopefully here, let me make sure I'm unmuted on this other side here, because I have an interesting mic set up here. All right, yeah. So I'm gonna jump in here. I got all kinds of good questions, I think. So when you're talking miners, and this is really for the folks that are on the watching out there, we're talking by and large pools. Most of the mining hash power out there, like if I take a snapshot of the last 100 blocks, typically I get around 26 separate block, individual addresses or pools. It's 26 to 30. Sometimes randomly we might get up to 35. But by and large, most of this traffic is going to the major pools. So a lot of this activity that would have to get set up would be around the pools. So I'm going to talk from this point on around the setup of the pools. Most of these activities, I have about 3 to 4 that you've laid out. So one is essentially getting in the arbitrage part, right? So where the pool would have a set of funds, blocks that they won, they would already have some kind of scripting set up to look for this type of activity and then just execute accordingly. They're looking at DEX transactions. They're looking at a lot of these different opportunities. The opportunity cost essentially probably has different scenarios that they're looking for, and then they would go and execute with some funds that they have to try to get ahead of that transaction. I'm assuming that first part is the way that would work, right? Okay. The second part.
Yes. The one small caveat there is sometimes you can do these arbitrages without having any funds in advance. Like there are opportunities that present that sometimes, like those Oracle updates, for example, they actually require $0 of upfront capital. Like you literally just need the right position to execute them. Like you need an opportunity to execute some code, and that's it. You don't need to front any money. You just need to show up and run some code on the blockchain, and miners have the ability to run code for free, basically. You can do a 0 GWay gas price transaction as a miner because it's coming out of your pocket. And so you just run that transaction and you get the money. But yes, some of them also do require upfront capital, and a lot of these people do have some capital they're working with.
Yeah, great. Okay, yeah, I wanted to clarify that, and that is a good, from a distinction, from a category standpoint of like these things are gonna, for them to play in this, that's a size of pie that they'll want to have on hand to be able to maximize the advantage on that particular piece there. The censorship transaction piece, we'll come back to that because I got some other different questions around that one. But
sure.
So the pools essentially would need to set up a series of business rules, and they probably already have some of these in waiting. I would assume that they're tracking a lot of this at this level. But the real question, I guess, comes down in these little side deals that they could have. And I like that you explained, if you could see it on chain, but I'm almost envisioning, and I would call this would be my, like the, I don't know, white hat, black hat kind of, way of thinking of things on, the DEF CON style, where wouldn't it be advantageous for them to set up something like I would call like an interface agreement or some agreement with some large arbitrage market makers to do that stuff all off chain? And it is one of those things that you would have almost like a cartel kind of set up to where they're just playing a flat fee to ensure that if they do, because it's all predicated on the pool winning a block, right? And none of the arbitrage folks can guarantee which pool is going to get a block, right? That's part of the beauty of random chance. But having a preset arrangement where they would never expose the fact that they're getting it under the table, right? And this is going to be also a question more for the pool when we get some pools on there. And obviously, they have every reason not to tell us. It's just to at some point, like I would imagine if they're in operation, they have to report their revenues in whatever countries they're in, that they're going to have to at least disclose that at some point of where the revenues are coming from. And as these transactions get larger, as crypto gets larger as a whole, there's going to be a want and a need from their side to be able to partake in this. The real question is how much of that are they actually sharing with the miners? And obviously you can't answer that. It's unanswerable.
As you alluded to, there's definitely some risk here that the pool operators may be taking side deals. Like you can set this stuff up to be off chain. There's a few caveats there that kind of protect the individual hashers a little bit. One is that getting in touch with pool operators is actually relatively challenging for backroom deals like this. I've talked to people that have tried, and it's not trivial to approach Spark Pool and convince them to trust you, with some sort of side channel deal. Like you need to convince them that it's worth enough. So Spark Pool is, they're like 30 or 40% of hashing power right now, and so you have to convince them that it's worth them taking their time to talk to you. And as these arbitrageurs, a lot of them prefer to remain anonymous. Like they don't want people knowing who they are. This is like the arbitrage stuff isn't illegal, but a lot of people don't like it. It's not like a lot of people consider it an unfriendly business practice to be getting in there. And the only reason you're making money is because you're faster than the next guy. Like you're making money off of some poor sap who just did a big trade and didn't realize that he needed to be more careful with it. And so a lot of people like to remain anonymous since they don't have like these big public profiles. They don't have a YouTube channel where they're talking about how much money they're making. And so when you email Spark Pool or whatever, and you say, hey, I want to, make an arrangement with you, you don't really have any proof that you're willing to share that shows that you can make Spark Pool a lot of money. So it's hard from like a human organizational standpoint to make these connections. That doesn't mean the connections aren't there or they won't be there. It just is hard to do it. The other caveat is that Spark Pool is like the arbitrageurs also don't trust Spark Pool. So, Spark Pool maybe gets an arrangement with you, but you don't know who Spark Pool is. You don't know who the operators are. You don't know who's running it. And so it's possible that Spark Pool says, yeah, go ahead and send us your transactions. We promise we'll include them. And then they just don't. Like, oh, we didn't mine the block, or oh, someone else paid us more. And really, that's their own thing that they're running on the side, where they're just taking your stuff that you're giving them and they're rerunning it as their own. And so it's this kind of weird trust relationship where neither side trusts each other, and it makes it hard to coordinate, even though coordination is very possible. I don't want to discount that. It's something that we should all keep an eye out for and try to spot when it happens. But keep in mind that it's not simple, like just again, from the human standpoint. The other issue that makes it a little challenging is because as an arbitrager, you want to have these arrangements with basically every block producer. You don't want it to just be Spark Pool or U2 Pool or F2 Pool or whatever. You want it to be all of them. And so because there's not a huge number of miners in the top 90%, but there's enough that having all those kind of separate contracts becomes complicated. And again, this is the human aspect complicates things because it's hard to manage that many contracts with that many individuals, especially when these guys, are software, like people who are finding these things are generally just software engineers. They're not like these big companies. They don't have, a whole team of sales representatives who are making contacts and whatnot. There's like a dude in the basement, writing code. And he's like, okay, I want this code to run somewhere and I need to find someone to run it for me. And I don't know anybody, I don't have connections to, the billion-dollar mining companies in China. I don't have connections to this. And that kind of gets us into the MEV Geth, or the Flashbots group. And this is a group of people who have the goal of trying to, they call it democratizing this, where they're trying to make it so there's a shared marketplace where anyone can go and say, hey, I've got a transaction bundle, is what they call it, that I want to run. So I want to run these transactions in this order. And they can broadcast it out to a bunch of different mining pools. And someone else is taking care of finding those mining pools and getting them involved on the other side. And then it's more of like a marketplace. And so the advantage of a marketplace is that it's a little more out in the open. And so you can see it, which makes it a little more easy to tell when one of the pools is perhaps cheating. And if the pool is cheating, then you stop communicating with them, because we have, all these arbitrageurs are sending to this marketplace. And then if you notice that, Sparkpool says they're part of the marketplace, but they never mine any blocks with anything from the marketplace in them, it's very suspicious. And because it's out in the open, we can see that, we can track it, we can record it, we can, have dashboards that show, what percentage is actually, which percentage of the, the hashing power is actually including this versus what claimed to be including it. And so that kind of helps a little bit. So there are certain things we can do to try to mitigate those and limit those back channels. And interestingly, this is part of why Flashbots was set up, is they were concerned that if they didn't set up this marketplace, was that the marketplace would be set up by somebody, but it would likely be a dark pool. So it would likely be behind the scenes and no one would see it. And that makes it much harder to deal with, makes it much harder to get into, because you have, like you said, a cartel, and it's very dangerous. And so it's a very complex situation. There's no easy solution here. There are some solutions that are in place now that make it better and make it a little more in the light, but this will, over the long term, there's definitely a significant risk, I believe, that this will tend toward dark pools. And when it tends towards the dark, it gets very hard to track, and that for individual hashers, that becomes problematic, because you want to be confident that your mining pool is giving you all the rewards they're getting, and they're not pocketing some of it on the side, right? Like you guys are thinking, okay, my mining pool is taking 1%. I expect that means I'm getting 99% of it. You don't want it to be like, oh, my mining pool says they're taking 1%, but in reality, taking 1% plus everything they can pocket on the side that's not accounted for publicly. And so we'll see how this works out long term. For now, I think we're kind of safe from what we've seen in terms of statistics and whatnot. It seems like fairly few of the pools are pocketing stuff on the side, but we don't know for sure.
Yeah, well, and I mean, at the end of the day, the folks pointing their rigs, they can easily, if they start to see or they feel like they're not getting their full reward. And a lot of things come, or I get a lot of questions. People are like, hey, the calculator said this, and it has nothing to do with the pool. It has everything to do with like the difficulty adjusted. And it's people starting to understand that, hey, it's a little harder to mine. Welcome to the community. And here's how you kind of calculate that. But I think if you start seeing the pools don't control a lot of the hash power, or don't have a huge amount of farms themselves, right? They're setting a platform and then hoping people will come to them and enticing them in whatever way, right? So mainly just the hard part about getting the hardware, right? I mean, if the hardware was easy to get, then we would see that more, or if it was out of only one channel. This is why we get real concerned when we start hearing, shadow ASICs that might be out there. A private investor invests, $50 million and goes out there and buys a whole bunch of ASICs and never sees anything. That's part of the concern there, is that force projection of hash power never sees competitive opportunity at selling. That's part of the risk. If it really proliferated, now you would have all these dark pools that now it's all one group. That's part of one of the main concerns with that. I'm going to pivot real quick and ask, so to delineate, because I know a lot of the questions come in this right now. Right now, we can capture and identify those particular activity right now. But the main question is until EIP 1559, it's kind of a moot point, right? We're getting the whole transaction right now. If you're mining to a pool and it wins a block that's comes in at 115, there was one earlier last week that was 115 Ethereum in one block, and that particular pool, I think it was Ethermine that got it, that got shared with everybody. So it wasn't about that. There's more to extract right now. This is really an opportunity cost when it comes to the mining pools setting up this kind of activity post EIP 1559, correct?
I know this is opportunity right now. Like there are, I think UU2 pool, is that what they're called? I know that they are doing this. They have, so in the Flashbots channel, they're one of the first miners that got on board of significant hash power. I think they're at 2% or something of all hash power, which is significant for these people. They are doing this right now. So they are, taking these requests from Alice, Bob, and Carol, who are all competing, and they're taking a side channel payment in order to allow Alice, Bob, or Carol, one of the three, to choose how transactions are ordered within their block. So basically, UU2 pool is saying, hey, we'll do transaction ordering the default way, but if someone's willing to pay us more than the default gives us, we'll let you order the whole block. Like we'll let you decide exactly what goes into this block, as long as you give us more money than we would get from mining the block by ourselves. Like, so they just take the naive strategy by default and then let anyone pay them to choose the order of their block. And any mining pool can do this right now. I think the Flashbots currently has a closed alpha, so they are looking for mining pools with significant hash power. So you've only got 0.0005% of hashing power. They might not let you in right now. I think they plan on opening that up very soon to be open. The reason they did a closed alpha is because just from a support load standpoint, they didn't want 10,000 individual miners all asking them for help while they're still debugging their tools. But I think their tools are getting more mature and to the point where they can open it up and not have to worry so much about getting flooded with support requests. But yeah, so right now we can do this. This is unrelated to 1559. The reason I brought it up in the 1559 call was mainly just because it seemed like there was a misunderstanding of how this works. And I wanted to make sure that everybody was fully understood that this is a big opportunity. And and also, so pivoting very slightly, when it comes to 1559, so circling back to the 1559 debate a little bit, that big block you saw, the 11 ETH block or whatever, if that block were to come in, do you know what the normal, like right now, what would you normally get from transaction fee revenue in a block? It's like
right now it's averaging about
like
it's averaging about a 2 extra. With the spikes, when this price started going down, it was around 8 or 9 extra, which was a total of like 10 to 12. Okay. But average right now is 4, so an extra 2.
Yeah. Extra 2. Okay, so right now you get an extra 2. So when you see those giant blocks come in, the most likely, I'd have to look at an individual block to tell for sure, but most likely post EIP 1559, you would still get most of that. So you would lose out on that 2 extra, like the normal part, like whatever is average for that time period. So if it's about 2 per block on average, that's extra in terms of the fee revenue. That's what you lose to 1559. When you have like 1 block out of the blue that spikes up to 11, and then the ones next to it are both 2, that spike up to 11, so that 9 ETH difference, that would still go to miners, because what that 9 extra ETH is almost certainly, like if it's just for 1 block that you see a huge spike, that's almost certainly gas price auction, where these Alice, Bob, and Carol are bidding against each other really, really fast. Like when I say really fast, I mean like every quarter of a millisecond, every like quarter of a second or eighth of a second, they're sending updates where they're just bumping their gas price up, because they're trying to stay in front of each other until the block is mined. And so they're participating in this very, very fast auction that happens when those Oracle updates come in. And that auction is all in the inclusion fee or the miner tip. So that part is still going to miners after 1559. The part that's not going to miners is that base part, that 2 ETH that you see every single block. So if every block for like 6 hours is about 2 ETH over, that part's going to the burn. Anything above that spikes up for like 1 block or maybe 2 blocks sometimes. So sometimes when you have these auctions, they get so intense with so many participants that it actually fills up an entire block and overflows in the next one. And so in those cases where you see a very short spike, I almost guarantee you all that extra money would still go to miners as the tip or inclusion fee. And so again, that's in your example, like if it's a 11 ETH block, that means, if it's 11 ETH transaction fees in a block, that means you've got the 2 ETH base that's going to be burned, and then 9 that's going to go towards the auctions. And that, again, all goes to the miners. Does that clarify a little bit?
Yeah, that's actually a big, so thanks for clarifying that. That was after that call, and I started looking into it. What I was trying to set up was I'm calling that right now a color of money. Okay, so like if you have the 2 reward and then you have the base transaction transfer that's going on with people just trying to move money, that's the stuff that's getting burned. And then this is like another color of money. Moving forward, being able to see and project, what that could have been. That's my current task right now that I'm trying to do, is look back in history. And I know Hazu, I think it was Hazu that was on the call. Maybe saying his name wrong. HASU. He just wrote the article on. Yeah, the German guy. I don't. But I think he just did an article on this to try to look back at the history, because one of the things I was wanting to do is the model that I had built to show some of the risk if we get into a situation where Ethereum starts to decline in price and we see a lot more transaction activity, and people will be like, why is that happening? Well, because DeFi is still around and people are going to be looking at transactions and like, hey, well, ETH's only 300 and now my transaction is only going to cost me $15 to do because ETH's cheaper. And now the volume side goes up. Part of that model is that now we're looking at 10 ETH blocks, 12 ETH blocks from a transaction value. And then if that snaps down to 2, that was part of the risk of like, you could have like 70% of the hash rate drop off by June if the ETH price was way down. That was just one of 10 models. But what needs to happen is that model needs to be updated to delineate the color of money there. So if that 10, if 8 of that is stuff that would still be included, that completely changes the model, right? So that's an important detail.
It's not too hard to tease it out. Depends on, like, there's like the easy tease, like where you can just tease out, kind of get a ballpark for it. And the way you do that is just by looking at the average, gas transaction fees volume per block over like a period of time, and then look for outliers. So any block that's an outlier relative to the blocks around it is almost certainly all going to the miners in the end, even after 1559. So that's the easy way. That gets you kind of close. There are more advanced techniques you can use where you can look at each block individually and then look at all the transactions in that block. And if you see like usually in a block, you see the transaction fee per transaction. Like it'll be like 100 GWay, then 101, then 102, then 105, then 110. And if you see a big jump up to like 1,000 at the top, that 1,000 at the top is almost certainly, someone participating in a gas price auction or doing something that is out of line. And so that gets you a little bit closer. And there's more advanced techniques. I think this is kind of what Hazu got into a little bit in his article. I think he was doing some of the more advanced stuff where he's trying to pick out the Flashbots. People also have some tools they use to try to identify these front-running transactions and the back-running transactions and all that stuff. It can definitely get complicated pretty quickly, but you can at least get close by just looking at the average block price and then looking for outliers. That gets you into the right ballpark.
So my mind's already going with what my next steps are. So there's that part from the analysis from the history that I want to do, but I think there's also an opportunity that, so let's say ETH call next week goes 1559, it's moving, right? Next steps after that are obviously dropping stuff to testnet, correct? I don't think, and I don't know if there's an opportunity, if we have the ability, let's go this way, to, because I don't think the whole DeFi network's all on a test net, right? We haven't forked the test net to have all that level of detail. But in theory, couldn't we have some unit tests that would go out there and emulate those type of events on testnet right now to validate that the size of pie or the color of money based on a series of high volatility times, and then we could start to delineate like, hey, in this time series over a weekend, something occurred and now we had this spike. Here's the transaction burn. Here's the remaining mining inclusion. I would assume that they have a unit test or some series of tests that they're going to be able to validate at least the transference of that. So that would be a very critical piece to the mining community to be able to see those test cases on a live test net. I don't know if that's part of the stack or not, but I'm thinking forward.
We've talked about it. So currently when we do testing, the test nets tend to have very different transaction volumes than mainnet, obviously. Like not only in terms of volume, but also in terms of what's included and how people participate and stuff like that. Like it's a very different environment. And so just looking at a traditional testnet doesn't give you a representative example of mainnet. That being said, very recently we started talking about doing a new type of testing where we actually run a mirror of mainnet basically that runs under new rules. And I don't know if this will make it in time for London because it requires infrastructure to build this type of testnet. It's not terribly complicated, and I'm personally hopeful, but I'm not a core dev, so I'm not the one who actually has to do the work. I just talk a lot. And so if we can get that type of testnet in, then that would help a little bit, but there's some caveats there with 1559 specifically. And the main thing with 1559 is that right now, the way gas pricing works is when you decide what gas price you're going to set. Like you say, I need to decide how much I'm going to pay for this transaction. What you're trying to do is you're trying to guess how much everybody else is going to offer to pay for a transaction in the next block. And then you want to beat them by as little as possible because you will pay as much as you bid. That's what you pay currently. And so the model right now encourages people to try to estimate future transaction prices and then beat them by just a little bit. With 1559, this is the big UX improvement that everybody's talking about. With 1559, the model changes. So now you are saying, I am willing to bid this much and I will not overpay. So now I can just say, you know what? I really want this to go through. I'm willing to bid 1 ETH. And you can bid 1 ETH, and if it only costs like 1 ETH per gas, and if it only costs you, 1 GWay per gas, then you only pay 1 GWay for gas. And so the users that we're seeing are operating right today on mainnet in a certain mental model of how they choose their gas prices. And after 1559 lands, that mental model of how they choose their gas prices changes pretty significantly. And so it's not totally representative. So that being said, there is still value in what you described because we can at least get a good idea of how much people would have paid, kind of. Like we can get a ballpark via modeling. And I think we can actually do that via backtesting as well. I don't think we need to mirror live mainnet to achieve that type of backtesting. And the reason is because we can look at the transaction history and how much people paid for each transaction. And then we can kind of model or guess what the base fee would have been in that block. And it's not going to be exact because, again, people's mental models are going to change in terms of how they ask gas price before and after 1559. But we can get kind of close using backtesting of the way you described. And interestingly, that same backtesting model works just as well as a forward testing model. And so we don't really gain much, I don't think, by doing testing live on mainnet for that particular thing. Like we can just look at the blocks after they're mined and we'll get the same amount of information. There's not additional information that we can get from the pending pool.
Correct tracking. Yeah. And I was just thinking as you just explained that, I mean, I immediately started thinking, okay, yeah, there is a change there. So the behavior on some of that transaction activity is going to change, and we don't yet know. We have forecast of what could happen with that, but until it starts to actually happen, we won't know the level of adjustment there. However, we're not. It's not, changing the front running behavior, right? There's still going to be arbitrage. We're not changing the way the MEV works, right? So
100%.
there's still going to be that activity, right? So
that all that activity will still be there. You guys, miners will still be getting the bulk of it. Like when you have these people that do these front running transactions, I've seen them. I've seen gas prices that are 10,000 or 100,000 GWay per gas in these front running transactions from time to time. Like these are orders of magnitude higher than everybody else is paying, and it's because they're basically fighting with each other. A long time ago, there was an interesting one. There was like one of these Ponzi scheme games where the attackers they needed to ensure that no one else got a transaction onto Ethereum within a certain number of blocks. Like they had they need 10 blocks that no one else was able to get a transaction in. So they're basically censoring for 10 blocks. In order to do this, what they did was they just basically outbid everybody for 10 blocks. And so they paid a huge amount of money to make sure that no one else could use Ethereum for like 10 blocks in a row or whatever it was. And because of that, they were able to then make, I don't know, it was like $3 million or something at the end of it. And so, those people, they don't care about the base fee at all, because the base fee, if it's 100 GWay, like they're like 100 GWay, I'm paying 10,000 GWay per transaction for an entire block. Like I'm paying, 100 grand to ensure these blocks are full of my transactions only for 5 blocks. And so it ends up that for them, the burn is just totally inconsequential. Like it does not change their strategy in the slightest. Everything they do is identical to what it was before. Their behavior will not change. And so that's where if we can identify that colored money you were talking about, if we can identify which of these transactions are that kind of darker color, the black hat money or whatever you want to call it, those transactions, they will not see a behavior change. They are still going to be bidding exactly the way they do today. Like they are not going to, I don't even think it's like 1559 has new transaction types, so people have to update their tools. I don't even think that those people will update their tools. Like it's just not worth it to them to put in the 10 minutes of engineering effort required to deal with the base fee. Like they will just completely ignore it.
Yeah, and that's why I think it's important, especially from just a transparency and understanding for people to, and I don't know, maybe that phrase will start to catch on, the color of money, but that's essentially what it is. It's a category based on a set of rules, and there's a separation out because one of that category is now going to be burned. Yep. There's this other category that's still going to be around. But if we get an instance where we start having a dashboard and we see a gap like that, when we see a big block come in and all of it got burned and people are like, what the hell, what changed? That's a very important distinction to know that, well, they just did everything through just straight gas prices and that's going to get burned because that's that color of money, right? So there's almost like a key or a dashboard that will get hopefully identified on some of these pools. I can just imagine a pool. It would be advantageous for a pool to, one, state that they're trying to obviously take advantage of everything that they can here and say, hey, we are going after this for your best interest, send us your hash power. With that, they also have now a new portion on their dashboard that's showing that separation. Hey, this got burned. This is what our pool, was a contributor of the blocks that we got. This is what was burned, right? It's almost like an advertisement now. To show the deflation piece of it, but then show that, hey, we're still able to return this much to miners. And then you would see and have a better education at a pool level. And this is really good that we're having this conversation because the next kind of call I want to have is with pool operators. And then just, kind of go back to this. Hopefully they can pre-watch this to get a better understanding.
Yeah, the pools are definitely the ones that are going to make this choice because they're the ones who are choosing the order of the block. And I think it's up to the hashing power to put pressure on the pools to say, hey, and this you can by pressure, right, that could just mean you just move to whichever pool is giving you the most fee revenue from this sort of front running activity. And so if your YouTube pool is getting the most because they're participating with flash bots, then if the hashing power starts moving to you to pool, then Ethermine or whatever is now incentivized to, hey, I want my hash power back. In order to do that, I need to invest resources into making these connections, getting in on this front running stuff, getting in on the back running stuff, getting in on the transaction ordering, and caring about those things. And so miners themselves don't need to fully understand it. They just need to understand what to look out for. What does the average GPU miner, home GPU miner, need to look for in a pool, and how do they identify which pools are give them the most reward based on which pools are the best at doing this front running stuff and the back running stuff and the MEV extraction.
Yeah, and I think with the update of the model, then it'll delineate of what that loss delta is, a better forecast of what that base fee that we're going to lose right now, and either based on some of those models be able to justify that one block increase that we were talking about, or that I had proposed before, because I think that's still I know everybody hates. I know we had talked this in our call yesterday with the group, but everybody hates the word compromise. But I think it's there should be a good transition period, and coming into this, and then a transition period when POS comes out, and there's got to be some level. I mean, this is now getting into, I guess, the politics I said I wouldn't get into, but I still feel very strongly that, given the set of circumstances as we see this forward, that there should be a serious consideration. It's all off the table if ETH's 10 grand, right? If we come into July, profitabilities to be through the moon, and it's going to be really hard to justify to increase also that reward. But I'm looking also from the security side of it, and that any retraction of hash power in a proof of work element is, in my opinion, a bad thing and a risk. So I think it still needs to be out there. I'll still be pushing that all the way to probably the day they go live, to be pushing for that that +1 block reward. We don't have to get into that now here. I know there's no real influence to push on that, but now I'll still talk to that. But the models should be able to just plainly explain if that's a requirement when we get near there. It shouldn't be a huge update for them to make sure that they can implement that. And hopefully they bring it up in the ETH call next week. But the data's got the data has to line with it at close to time. So it needs to be like on the fence all the way to the end, and then it's going to be super predicated at where ETH sets at that time. I think I might have muted myself.
Yeah, I think for miners wanting to convince the core devs to pay more, I think the strongest argument that can be made is if you can show a credible threat. And that can be, so there's a couple ways to show a credible threat, of course. So there's the racket scenario. So when the mob comes in with a bat and to your store and threatens to smash all your things, a credible threat, and the person will pay you racket money, right? That's not a very friendly, of course, way to make a credible threat, but it is credible. The other way to make a credible threat is to show that, if you don't, pay more for security, it is likely these bad things are going to happen, and be able to, prove that in some way. One way to do that is, hashing, significant, as I mentioned in the call, significant portion of hashing power going to nice hash, especially 50%, is a very credible threat. Like, that is exceedingly dangerous to Ethereum. And so the trick is showing that is likely to happen. And that's where, like I mentioned, things get much more fuzzy. Like when, in terms of proving that's going to happen, it requires forecasting and modeling, and everybody disagrees on exactly what should go into the model and what the inputs are and how the model works and whatnot. And so that's more tricky. But that is a good, if you can somehow prove that, like prove that 50% of hashing power is going to nice hash when 1.59 lands. That is very dangerous, and the Ethereum devs will need to watch out for that. I think the challenge that miners will have is convincing people that will be the case. Like, it's hard with just models to convince people. As we see, you've got global warming models, and not everybody believes them. Some people, there's a dozen different models. You've got COVID models, and not everybody believes them. There's a dozen different COVID models. Like, it's really hard to convince people with models alone and forecasting alone. And it just makes it challenging. I'm not saying it's impossible, but it's very hard. Whereas if you actually physically see, 50% of hashing power in nice hash. That's very convincing. Like, it's like, okay, this is a real thing. Like, that can happen. And so, hypothetically, one way miners could potentially do that is by all coordinating and just saying, hey, let's all move our hashing power over to nice hash for, a few hours, just to prove that that is a real scenario that could happen. Like, prove that miners have the ability to coordinate and have the ability to, you don't lose much money. So like, nice hash might not pay as much as self-mining or pool mining, but at least it's not totally knocking your profits out. But just showing that you can move all your hash power, quickly, turns it into a credible problem. And instead of just a forecasted problem or modeled problem. Again, I don't want it to get into, I'm not the person you need to convince, so I don't want to get in too deep into it, but I do think that is the best bet. If you can somehow, show that this is a real thing that can happen, and prove it by showing that it actually happens, like showing this event occurring or getting close to occurring. Like, if you got 40% in, I would personally be convinced that's very credible. Like 40% is enough to cause serious damage. So again, sure. Just my feedback to miners, if you can make that happen, that's a good way to prove that this is a real problem. And just because models are so contentious, just throughout the world, not just here, like, this is just a problem with humanity. People don't tend to agree on forecasting models. Like, everybody has their own forecasting model, and it's hard to tell which one's true until after the fact.
Yeah, for sure. I mean, and that's why, like, I was trying to do it more, I mean, it's through a model, but it was trying to do it eloquently of like showing history of actual events, right? Like, so this isn't to be confused, because I think since we're in kind of a finance space with this, that people are like, well, history isn't indicative of future gains. This is not in that same parsec, right? This is a completely different type of argument where physically this has happened to a whole bunch of different networks. And the right set of circumstances were all it took to get in place. The know-how, the scripts, the intention, the incentive, everything is there if the conditions are right. And that's why I was trying to get those models to show, if you had a specific scenarios, it was not if, it was a when type of thing. There was no question that, because it's happened several times to some of them, especially ones that had VTash as its core algorithm. The other counterpoint was that they would put in a 51% resistance as part of that, right? And then just omit the whole thing about paying miners, and then put like MES or gravity well or something in there that makes it a hard exponential to do that. But that's like a level one, protocol change. And I would think that, they thought changing the algorithm was an adjustment. You're effectively adjusting the way things work if you start trying to put in some kind of resistance feature in there. And I'm like, at the end of the day, it's like +1. Like, you're gonna potentially burn a lot more than that. So it was kind of a compromise, as it were. But if tomorrow there's an EIP or a stop EIPP / go put all your hash on nice hash, I'm not saying I'm pushing everybody to do that. I'm just saying that what will happen is the natural order of things is somebody's going to see an opportunity. And if that opportunity is worth it to some individuals to start spotting up that pricing, there's just a lot of people that are not watching this channel, that are not paying attention to anything besides their hash rate and their returns, and are going to look where that highest return is. So the incentive is out there to push, a big bid order for a couple days out on nice hash for $30 million. And you're going to, that the way that information travels in the mining community is quick and fast, and people immediately will start to switch over to it just because they're going to chase those profits. So that's where it was at. I mean, again, things knocked that model off. The price of Ethereum, which nobody can control, I don't even think artificially, when things are changed, that changes the models too. So, but all we can do is we have the forecast, we have an actuals that we'll keep putting in, and we're going to just talk the latest estimates. And I'll just keep on that focus to make sure that it's heard and they're tracking it. It's in their best interest to track it, right? I mean, nobody wants to see anything bad happen with it, and they should keep their eye on the wheel. I mean, it's just, I think some of this discovery that we're looking right now with this MEV to see how malleable it is on, some of the previous history is key. Showing that color of money is key. And then those models will be updated with history, just like the people moving to nice hash potential, the previous MEV data being applied to what has been, awarded. I'm already looking at, pulling all the blocks in, who won the blocks, what's the color of money on that, and then what was the real returns based on that, and then show that delta. And if it's not as bad as people think, with how big of a slash it's going to be, it might change some mindsets. Again, it's still a cut, but who knows? I mean, a lot more transaction activity. There's a lot of other positive things also that come out of people being able to use Ethereum that might drive up more opportunities like that. But just the best way we can do is put out the content out there and inform people.
Yeah, I would personally, just from a security analyst point of view, I would love to see someone put out a giant bid on NiceHash and see what happens. I'm very curious, honestly. Like, ignoring Ethereum safety and all those things, I think it'd be fascinating to see what would happen. Like, exactly how fluid are miners? Like, this is something that's kind of amorphous to me, and everybody has different claims on how fast miners can move hash power or do move hash power, and how fast information travels across the network. I would be fascinated to see, what would happen if someone just said, hey, I'm looking to buy, 200 terahashes per second on NiceHash for an hour. Like, would they get half of the hash power? I don't know. I honestly don't know. And I would love to see that. The other thing that I think is important, circling back to the MEV stuff, I think it is important and valuable, and I don't know if anyone's done this yet, to keep an eye on, to build some sort of dashboard or something that keeps an eye on how much money the blocks Coinbase made beyond the transaction volume, because that kind of is an indicator of that back channel payments. And I think it's very important, especially again for individual hashers, to know, is their pool getting back channel payments? And if so, are those back channel payments getting paid back to the users of the pool? So if Ethermine is getting that 98 ETH in a block that didn't show up in a transaction fee, is someone noticing that? And if they are noticing that, are they verifying that Ethermine then paid out more to their miners for that block or not? And I don't know the answer to this. Maybe the pools that are getting these back channel payments are already distributing them to their miners, or maybe they're not. This is a big question mark for me. But I think it'd be very valuable and something that is definitely in the best interest of individual miners to figure out and monitor and track and share with each other, let each other know, hey, Ethermine made 100 ETH in that block and it just disappeared, versus Sparkpool made 100 ETH in that block and their miners got paid out more. And just be able to see that and track that and share it, I think, is very valuable.
Yeah, and I mean, now the way you explained it, I think it's just dumping that data out and then looking. I mean, I can hit the Etherscan API and probably pull that in there and just put that rule in there. It shouldn't be. I mean, obviously there'll probably be some massaging that'll have to be on the data cleansing side, but yeah, I mean, now that I know what to look for there, because I was not tracking that, I mean, I could probably put that together, at least a rough draft, and then make it to where people can see it and see how it came together, and just point it out, saying, hey, no, you're wrong here. This is normal. This part is, and then use it as a community build. I'm interested to see that too, and not to call out any pool. Hey, here's the deal. I know there's maybe some pools watching here. I'm not going to call you out on it, bro. But like once we get it, like if that's a thing, like for one of the pools there, it's like the cat's out of the bag. What happens after that, right? Because I wouldn't call it bad press at the first part, because I would say it's an opportunity cost. And now that they've had X amount of time on that opportunity cost, and if that cat comes out of the bag, then maybe their movement after it is like, we put some effort to it and we understood what to do, and we made some extra money from it. But from this point on, we're sharing it, my dudes. So that behavior self-corrects since they're consuming our hash power. Because if it doesn't correct, we just move our hash power, right?
Yeah, definitely.
Excellent. I'm going to open the floor real quick. We've been going for about an hour, 10 minutes. That way we don't have to cause this one to be like our average stream time, which is about
so guys, get in your questions down in the comments section.
Seth or Vega or Nemesis.
Let me forward your questions, guys.
You guys are on.
Drop in the chat.
If you guys have any particular questions from the crowd, we'll try to time box this to be no more than the 20 minutes totality. We'll lock it up at an hour and a half for everybody. And I'll try to look at some questions here in my chat too, but I'll open the floor if you guys have any. And it's okay if we close out early too, if you don't.
No problem. I think it's UU. So I'm not an expert on pools. I'm pretty sure it's called UU2 pools. They have about 2% of hashing power. You guys may know better. It starts with 2 U's, I know.
Okay.
And it's got pool in the name.
Okay, we could
UU2. Again, look around 2% of the hash power. I believe it shows up on Etherscan in the pie chart.
Okay, makes sense. Thank you.
And how does like with the EIP 559 with the burn factor? I mean, has anybody done any kind of like understanding of how this will implement when you launch the Ice Age 2?
Do you mean like how 1559 interacts with the Ice Age?
Yeah.
So they should be. So the current plan. So the Ice Age is going to blow up, is what they call it, around late July, estimated, and it varies depending on how hash rate changes over time. So it's hard to be exact, but it's around July. When we have in the past, when the Ice Age is about to blow up and proof of stake is not ready, which has been, of course, every time the Ice is about to blow up, proof of stake has not been ready. So this is our behavior historically we've seen. What happens is they release a hard fork. And what that hard fork does is it just prevents that explosion from happening. And so as long as that hard fork makes it in before the Ice Age, then it's as if the Ice Age basically didn't exist. Like we can just pretend it didn't exist until it was pushed out to. And so with regards to 1559 and Ice Age interaction, the only reason they are talked about in the same sentence is just because we know that we need to have an Ice Age diffusion fork before the end of July. And if 1559 is decided to be included and ready to be included before then it makes sense to include it in the same hard fork, only because coordination around hard forks is complicated, like making sure everybody knows to update, and like there's a bunch of communication needs to happen, a bunch of coordination between the core devs. Like it's just a complicated process. And so we'd rather not have a hard fork in June and then have another one in July. And so if, let's say 1559 is decided to be included and it is ready in June, then it would probably go in the same hard fork as the Ice Age, just out of purely for a coordination reason, not because they interact at all. Again, the Ice Age diffusion, if it makes it in time, results in the Ice Age just kind of disappearing. No one even knows it existed. So there's no, as long as the Ice Age doesn't happen, there's no interplay with other EIPs. If the Ice Age did happen, like we forgot to diffuse it or something, like we almost forgot to diffuse it 1 or 2 hard forks ago. So there's a big rise in hash power, a big drop in hash power, I forget which, and it resulted in the Ice Age date moving by like a month. And no one noticed it until like, it was a week before, 2 weeks before, something like that. So it's like, hey, the bomb's about to go off, so we should diffuse this. And so they had to rush to get a fusion out. But anyways, if we forgot the Ice Age or didn't diffuse it or something, then there might be some interactions because hash rate changes, block times change, stuff like that. In the case of 1559, I don't think there'd be too significant of a difference. I mean, it sucks for everybody when the block times go up because it means there's less space, and so gas prices go up, and it's rewards go down for miners. Like no one wants the Ice Age, basically. Like it's a sucky thing when it happens. Does that answer your question?
Yeah, that answers it really good. Thank you.
I had a question come in from my chat about are you part of any of the Flashbox activity, Micah? Are you talk to those guys and those devs? Do you know if they're going to release that Geth release?
I do talk to them. I've been hanging out with them since day one. I'm a big fan of the work they're doing. I've always known this attack vector was there, and I was always worried that it would end up in dark pools, like I mentioned earlier. And I would rather not see that happen. I'd rather see it end up in light pools. That being said, I am not privy to their internal roadmap if they have one. Last I heard, they are working on getting it out to public so anyone can use it. And again, the reason they went private alpha, I just want to make this clear to defend them a little bit, was just from a support standpoint. Like if they launched it and you had 1,000 miners all individually emailing them saying, hey, I need help, hey, I need help, hey, I need help, it's overwhelming, especially when you have an early alpha and there's lots of bugs. And so they intentionally targeted, just a few larger pools. I think UU2 pool or UU pool was one of the ones that agreed, just so that as the bugs came in, they could manage them. And now that they're to the point where they haven't received a stream of bugs, I think the plan is just to release that to a larger audience. It's not because they want to, this is like a big boys only sort of thing. It's not because they only care about the big people. It's purely just from a project management standpoint. That's the only reason they did a closed alpha.
Cool, thanks. Yeah, that was a question that came in. Most of the other stuff's been pretty straightforward. I mean, obviously we have folks in there that are still obviously upset with 1559 on the burn stuff, but I think a lot of it's also just understanding, what is the real impact, and that's kind of my next steps to see, how really truly how deep is that cut given the MEV activity. I know so let's put it this way. A lot of people will get confused on it because we've all known that there's arbitrage activity, right? That's part of the whole automated market maker. I've read the various engines that are out there. I've looked at the math to try to understand like transaction ordering. I got that. Like I've been tracking that since day one, right? That's how we make money when it comes down to how the order select works with a pool. I guess the delta was the fact that there's a consumption version of that, like a read only, and that doesn't work. And then there's what the actual maximization of that is where you are actually influencing. Once you have that right to that block, you are now making changes to it, right? That's the delineation from what the typical person understands of transaction sorting. And then this other MEV activity is where now that you've gotten the rights to write that block, you have some scripts off to the side saying, hey, cool, I've won this block. Here's what's in the mem queue. I can now go execute these other things because I know what I'm about to put in here, and I can get ahead of it. I can get behind it. I can do other activity that now maximizes the posting of that block. Is that a good representation of that difference?
Yes, that's definitely a good representation. So a little fun side story. So yesterday or today, there was an arbitrage opportunity, and some people may disagree with me on the term arbitrage here, but in a permissionless world, we'll call it arbitrage, where someone arbitraged basically for $14 million. And this happened at 3.9K ETH, 2.4 million USDT, 650,000 USDT, 250,000 DAI in one transaction. So one transaction.
Guys, I'm in the wrong business.
$14 million. And hypothetically, whoever mined that block could have seen that transaction and said, hey, that's a big arbitrage. I'm going to do that instead. And so they don't include that transaction, and instead they include their own that does the exact same thing. And now the pool just made $14 million in one block. Like that's kind of the best case scenario. And these things happen fairly regularly. It's like once a month we see a transaction like that, like a giant transaction where the author of the transaction started with $0 or some small number, and they ended the transaction with like millions of dollars. And again, like once a month we see these. And that is there. It's challenging, so that requires quite a bit of software engineering work to capture those. And this is part of why the Flashbots exist, is to make it so miners don't have to be those software engineers. You can have a marketplace. And so the miners would be like, hey, I'm auctioning off of my blocks. And these other people who find these opportunities can say, hey, I'd like to buy a position in the block and I'll pay you $4 million for it. And so the person who found it, they still get $10 million. And the block producer gets $4 million, and everybody's happy. And that's kind of the peak. Like, I don't think there is, I don't think I've seen anyone doing arbitrage and that sort of thing, but it's hard to tell because it's possible that someone did send that transaction and then there really was a miner who swapped it out for their own. And what we're seeing is actually the miner who just made $14 million. And in this one, I don't think that was the case. But again, this would be, look at the Coinbase. If the Coinbase went up in value by $14 million in one block, then they probably, did one of these things. Either they found it themselves, the opportunity, and they executed themselves, or they saw someone else executing the opportunity in their block, and they're like, no, I'm going to do that instead. And so that's kind of the perfect end goal. If you had a giant team of software engineers and you could build everything overnight, and that's what miners, I think, would want to be doing, is taking advantage of those opportunities. Those are the best ones. They're the hardest to leverage though as well. And so it does require some software engineering. And again, this is why Flashbots is here, is to try to make it so the software engineers can coordinate with the miners or the mining pools, so everybody can win in the end.
Yeah, I would think, and running just the theory of that forward, that it would be something that you would be like cherry picking, because you wouldn't want to create an environment where there's a balance to it, right? So if that was happening, and let's say the pools got so smooth at doing that and just front running all these awesome transactions as people are finding these opportunities, miners can just step back and just wait for them to come in. They don't have to do all that research and find that. And then they would just start swapping and replacing, because they get the right to win that block. They look at the transaction order set. I mean, mind you, they have to do that right now with 15-second block times. Otherwise, they have a chance of orphaning, right? So you have to make that decision immediately, because every second you're competing with somebody else finding that same block, right? And then you're in a race condition to produce it, right? And then you could orphan that, and you take a risk. Yeah, you could take a huge risk on that of locking your transaction up, because now somebody else got the block ahead of you, reorder sorted it differently, and the arbitrage didn't work like you thought it would have. And there's risk in there, right?
Usually what happens is the miner will mine just the fastest block they can. So they just do the default sort and send it off to the hashing power. The block producer will produce the fastest block they can, send it to the hashing power to start hashing it. And then while the hashing power is hashing that block, then they'll go work on a better block. So then they spend, like, I think Geth spends about 3 seconds building the next block. And then they send that to the hashing power and say, no, mine this instead. And then they work on the next block. And so you generally don't have to worry too much about uncle risk with these things, because what you're doing is you're starting from the default state of, I want to mine a block, that's what I care about. And then you escalate once you've got a block started on your hashing power. Then you work on, okay, now I got a little bit of breathing room, because my hashing power is all working hard on the next block. I have some breathing room. I'm going to start working on the next thing. And so it's not, the uncle risk isn't too bad there. As long as you engineer it right. So this is where, you need experienced software engineers to build, like MEV Geth. This is the thing that AlphaBot produces, tries to do this in a way that does not negatively impact uncle rate for miners.
Yeah, no, it's good and interesting, fascinating stuff. It's going to be a good, I think, single episode that I know I'm going to do. I hope that some of the other folks on the channel and folks that are watching that couldn't join us tonight on the recast take their unique creative approach at explaining this, because I think it's it's kind of like an Ocean's 11 type of thing. You could really dance this up to be very entertaining too, on the opportunity there, right? So I've always looked at it from a transaction order set, but just never really explored the arbitrage side of that. So any further than it happening, right? And us reciprocating the value of those blocks of it happening by seeing some blocks that come in that are higher. And luckily we were mining on the pool that had successfully was able to get that block, and just inheriting it that way. But yeah, it's been a very good discussion tonight. I haven't seen too many other questions. I don't know if anybody else is there. We're getting close to wrapping up. I mean, I can't thank you enough for coming on and explaining it and giving us some color to this discussion. And my next thing next to going back and looking at the history and updating the model is getting some pools on here. Hopefully we can send this video to them, let them kind of review it, and then see what they I would love to hear their perspective if they've already done it, they have examples and stuff like that. So I know Chris from FlexPool, hopefully he watches this, and if Ethermine or Two Miners, any of the other large miner pools want to come on and have this discussion with us, I think it'd be good for the ecosystem just to hear some of it, just from a conversation standpoint. But no,
I think in the community call, was it F2 Pool? They indicated they were looking into this sort of stuff as well. I don't know much about them.
Yeah, I don't know a ton about them either. It was kind of hard to hear and understand. I mean, sometimes, when English isn't your first language and, it's an international, this is a full international thing, right? So, trying to, the gap of communication sometimes is there to try to understand some points. And sometimes it's just a way to explain things maybe are a little different in different languages. So the articulation sometimes can be lost. But I think, anybody should come on that can communicate. And I have a few local friends that actually speak a few different languages. And if we need to have them there and we're doing some translation, I would love to have a good interaction with any of the pools that would want to come on with that. So I'll reach out to them and see if we can get something set up. So bottom line, any pool really that's participating in the space, that can help add some color to it, I think would be good. I don't know if you guys have anything else, so we can start to wrap this one up. Maybe we'll have you on, Micah, here again if you want to come on sometime after we either done with 1559 or if something changes with it or something like that, we can talk.
Sure. Did you want to talk at all about the proof of stake? I think you indicated you might have some questions on that.
I think that'll be a whole thing, man. Like we'll be on here for 2.5 hours. So I would like to. I almost want to. I don't know. What do you guys think? I mean, let's poll. If you have time, and if this folks have time, I'll make time, dude. I'll stay here for 4 hours and talk to you guys. I have some crazy live streams sometimes that go long. So
I'm free.
Let's take a quick poll. You guys want to hear some proof of stake stuff too? Let's see what I'm going to assume this is going to be a hard yes, but I'm running a little delay here, so we'll see here. But a lot of my proof of stake, there was a few. I'll tell you why we're waiting for them to come back, and I'm going to assume it's going to be yes.
So, guys, proof of stake. You want to hear about it?
I don't have
From
a
developer?
ton of information. I haven't really actually put a lot of time into the. Where
I think I want to hear about this. You guys let me know in the chat.
2.0.
Really. Pump it up. Hit that.
Sort of.
Hit that button.
For Beacon, I've watched essentially the block rewards, or I guess the mission that's going on there. There was questions I had with regards to the calculator and supply.
Yep, guys. Smash subscribe. Hit
held until the merger,
the bell.
that kind of stuff.
Hit the like.
Because
let's ask them some questions about proof of stake.
Out there was that some of the backdoor stuff was. Well, we got to bring the emissions down because we're emissioning now out on E2O right now. And now we have this kind of dual, inflation going on. So does it make sense to kind of pull back some of the revenues in some way from an emission standpoint? The risk there is that this change with 1559 is not it's just money moving around. It's not additional emission, right? So, that's how I've knocked down that conversation. Usually I'm like, it's not, this is more about just taking some of the supply out through a burn mechanism to ensure that certain bad behavior doesn't happen when you get into some of the changes that also are coming with 1559. But that, there is more Ethereum that's going to be in the ecosystem when these two merge, just because folks on proof of stake right now are earning Ethereum. I think it's at 0.25 right now. So people that have staked 32 ETH back in December now have earned a 0.25 ETH by and large. So people are, it's all hell yes. So on the chat. So yeah, we can spend a few cycles here if you want to kind of open up.
Sure. So I can answer your first question there on the proof of stake inflation. So I haven't personally heard of anyone arguing that we should do 1559 burn to deal with proof of stake and dual inflation. At the moment, proof of stake inflation rate is want to say like 0.2%. Do you guys happen to know what the current ETH total supply is offhand? I think it's like 120 million.
111, 110, 111, something like that.
111. Yeah, so I think if my calculations are correct, the current inflation rate is about 0.2%. So compared to minor rewards, it is incredibly small, and I think everybody pretty much just ignores it in terms of from a economics inflation standpoint. It's just so small compared to minor rewards, which I believe are like in the low single digits for inflation, if I'm not mistaken.
Yep. Well, I mean, yeah, just if we look at the
it's like
time, if we look at the time from just now, I mean, from when staking started to now, they've earned 0.25. But it's everybody, it's the entire scope. But yeah, I mean, you would have earned more with a single card, a modern card, but a single card since the same staking time. I thought about doing a video at this just to show the inflation difference. Like one single GPU mining, you would have earned like 0.38 or something. Yep.
Right. If you would have spent 32 ETH on a piece of hardware, you'd have made more money than if you would have spent 32 ETH joining the staking pool, basically, I believe.
Oh yeah, that like
by a significant
a lot more.
Yeah. So I don't think, I mean, again, I can't speak for everybody, of course. I have not heard of anybody complaining about the inflation from ETH2 staking. I think it's just considered a cost of testing, basically. Like the whole reason they started the staking before the merge was ready was to basically test the system in a live production environment. And so we're currently paying 0.2% per year for that test. And I think pretty much everybody is okay with that spending on that test. And no one's really worried about it just because it's such a small number. And again, you can double check my numbers. So the way you double check the numbers is if you go to launchpad.ethereum.org and you scroll down to the staking and rewards, it tells you the APR per staked ETH. And so you can just calculate, okay, that means this much ETH is minted per year, and then just divide that by the total supply, and you've got the inflation rate. So very, very simple calculation. And again, I believe it's 0.2%, if my math is right.
Awesome. Yep. Yeah, I mean, I'll open the floor. I mean, I'm more prepared for the MEV conversation. I have a whole list of other very technical questions that has to do with implementation, which I know is being worked on right now. With regards to like how state, I'll tell you, I'll pull one from it. So, and I know this isn't written anywhere, right? The implementation plan is being written as we talk. But just
yes, it's being written right now.
Yeah, literally right now. But just, I guess if we could just hit it from a theoretical kind of like, obviously not down to the weeds, engineering discussion on it, but like how certain activities is there a misconception that certain activities during any transition would have to cease? Like there would be a freeze period, as it were, when it came to like DeFi activity, any of the various states that happen. Okay.
No one wants to freeze the pool or freeze the transaction pool, like stop transactions from being processed for even like one block. Like one block we can maybe deal with, but definitely not for like hours or days or anything like that. That requirement makes the proof of stake transition actually pretty challenging because you're under this problem, and this is something that I've been talking with people recently about because I find it very fascinating. So from a miner standpoint, you have a piece of hardware, and that hardware can be valued in terms like from a accounting standpoint. You can value that piece of hardware in terms of its future rewards. Like what can that piece of hardware get you in the future? It's similar to how if you own money. And so a piece of hardware like a GPU or an ASIC or whatever can be used to do productive work that earns you income. And so that's why you put up that initial capital to buy the piece of hardware so you can make future money. What's interesting with mining is that if you have a big GPU rig, this is particularly true for mining for blockchains that dominate their hashing power. I think Tim likes to talk about this, where if you've got Ethereum and Bitcoin, basically the big two, where they dominate their respective hardware platforms. So Bitcoin dominates the SHA-256 platform. If you've got SHA-256 hashing power, it's by far the best place you can point it is at Bitcoin. Like that's where most of the hashing power is. And Ethereum is the same for GPUs and ETH hash and things that are in that same category. And so if you have a piece of hardware, it can be in your accounting, you can account for it as this is worth this much future ETH. And so if you have assume your card lasts for like 1 year or 2 years, I don't actually know what your guys' amortization rate is for cards, but let's say it's 1 or 2 years. That means if you buy a card today, then it will make you ETH for, let's say, the next year. And then you can calculate, okay, I estimate it'll make me this much ETH over the next year. And then that causes you to care about long-term value proposition of ETH. Like you want ETH in a year to be worth something because your card is making you future ETH. Like it's worth something in future ETH. If the value of ETH goes down, your card's value to you goes down because you cannot make as much money with it in the future. So what's interesting is when we approach the proof of stake transition, the cards, all the hardware's value in terms of future ETH goes to zero. So as we approach proof of stake, the future ETH value of any given GPU goes to zero. And so from a rational miner's perspective, that
is unless, of course, you sell those cards for
ETH price and continue to support Ethereum and continue to not attack Ethereum specifically, goes down towards zero. Because once proof of stake hits, if we go to the naive transition, once proof of stake hits, you no longer can make any ETH. And so if, let's say you're 1 block away from the proof of stake transition, so it's about to happen, you really have no reason to bother defending Ethereum. Like you don't have an incentive, financial incentive. You might have it for philosophical reasons or because you're a good guy, but you don't have a financial reason to defend Ethereum from an attacker. Like it's like, I'll lose 1 block. Like if ETH goes to zero in the next block, I lose, my percentage of 2 ETH. And so you're losing 0.0002 ETH or whatever. And so the fear and the worry here is that as we approach proof of stake, the financial incentives that kind of ensure that miners continue to behave in a way that is at least somewhat in alignment with the long-term value proposition of ETH goes away, like it starts to disappear. And so this is a very hard problem because what we don't want to see is that, as proof of stake approaches, someone puts a big bid up on NiceHash, like we talked about, and then miners previously may have said, you know what, that looks like someone's going to attack Ethereum, and my card's value is in future ETH, and I don't want Ethereum to get attacked, so I'm not going to send my hash rate over to NiceHash because I know that's going to be dangerous to my future profitability, and it's not worth the 10% gain that guy's offering. When we're at the proof of stake block or near it, that calculus changes. You now are looking at that NiceHash, the guy's saying, hey, I'll pay you 10% more if you switch your hashing power over to NiceHash. And you no longer like, he's going to attack Ethereum, but I don't really care because my hardware is, not going to be mining Ethereum anymore. Like if ETH goes to zero, I've already sold all my ETH, I'm out. Like I'm out in 15 seconds. I might as well get that last 10%, that 10% extra in those last 15 seconds or last 30 seconds or last 24 hours. And so this is a very hard problem to solve, and one these 2 people are discussing and trying to figure out how we can make sure the incentives are there to have miners continue to not want to participate in an attack. But it's a very hard problem, and it's a very real problem. Like one option is just to trust that miners are probably good guys. They're probably not going to attack us. It's hard to coordinate an attack. NiceHash makes it a lot easier, but it still requires a very wealthy individual to be willing to spend $1 million in over the course of 15 blocks. There's some other mitigations, like the most common type of attack in 51% attack is a double spend. And what we might see is that exchanges shut down withdrawals and deposits for 24 hours leading up to the fork. And so that might kind of mitigate the profitability of such an attack. But it's very hard to predict a lot of these things. A lot of these things are kind of fuzzy and they involve human interaction, human coordination, what other actors in the ecosystem will do, like will exchanges shut down? There are also problems like atomic swaps and whatnot. And so figuring out the solution to this problem is very hard. And it is something that is currently being worked on. There's lots of options out there. Of course, not everybody's happy with all of them. So one of them, as a simple example, is to just say, okay, so let's say proof of stake happens in July 2022. I'm totally making this number up just so we have a point of reference. Do not take this as an estimate for proof of stake. I have no idea what's going to happen. Let's say it happens July 2022, and we just say Ethereum proof of stake promises to pay miners for the next year. So as long as miners just keep hashing on proof of work, mining empty blocks, like we'll just keep paying you and for the next year. And that way, at the proof of stake transition, miners still have that future ETH value in their cards. So their card still has future ETH value as long as ETH has value. And so the one disadvantage of that strategy is, and this is where things are complicated, is that miners need to trust Ethereum. So what if Ethereum says that, hey, we promise to keep paying you for the next year, and then proof of stake launches, and then a hard fork comes out 2 weeks later that just turns that off. Like, so now the Ethereum core devs and Ethereum community have a pretty strong incentive, like 5% of the total supply, to just turn you all off after they made a promise. And that would be, very bad for reputation, but maybe that's worth it. I don't know. And so we don't want you guys to have to trust. Like designing these systems is all about minimizing trust. We don't want the miners to have to trust that the core developers and the users won't screw them over later. And we also don't want the users to have to trust that the miners won't attack them. Like, again, we hope that everybody, is on their best behavior and is nice to each other and works together. But when we're designing these crypto economic systems, we don't want to rely on that as much as possible. And so then we talk about these other options, which, okay, what if we ramp up the block reward leading up to the proof of stake block such that the proof of stake block itself, like the transition block, is worth like 10,000 ETH or something, or 100,000 ETH or some huge number. And the idea is that it'll encourage miners to stay honest and like stay in team Ethereum right up until that last block, because their future ETH value 1 block away from the last block is still very high. Because if that last block is worth 100 grand, 100,000 ETH, then you don't want ETH to crash in that short period of time. Like, you want ETH to still be strong right up until the last minute. Again, and then there's other things we can do. We can do things like, okay, what if we make it so miners have to leave their ETH like locked for a year or something? So when you mine a block, like leading up to the proof of stake transition, you have to leave your ETH locked in Ethereum for a year after the proof of stake transition before you can withdraw. So again, that trying to align incentives so that way these miners that are mining leading up to the transition don't have a financial incentive to screw over Ethereum. And again, this isn't because we think miners are bad. I want to make this very clear. It's because when we design these systems, we don't want anyone to trust anyone. And I advocate heavily that miners should also not have to trust the core devs. Like, you guys should not have to trust us, or I say us, but I'm not actually core devs. So you guys should not have to trust the people who are designing these systems to follow through with their word. Like, you should be able to look at the code and say, okay, the code says this is what's going to happen. This is guaranteed what's going to happen. I will get this because the code says I'll get this. No one in the world has the power to take that away from me. And so it goes both ways. Like, again, I'm not saying you guys don't trust us. I'm saying you shouldn't have to. And I'm not saying we don't trust you. I'm saying we shouldn't have to. And so proof of stake transition is hard. It's complicated. We don't know exactly how we're going to deal with it. We don't know the magnitude of the effect. Like, I think there's a desire to do some modeling on like what's the worst case attack scenario if exchanges turn off deposits and withdrawals for 24 hours or a week leading up to the transition. Does that protect us enough? It's complicated and hard. Is what I'm basically trying to say here in very long-winded.
No, I think you articulated it actually pretty well. I mean, the initial part of that question was more around like, the basic logistics of like the on-chain stuff, not even really particular to the issues that you just highlighted with miners, but just like the mechanics on chain and how that data moves over to the other chain. I'm looking at it from like a system move type of thing of how does all that activity move over? How does the smart contracts move over? Because
so that one's actually much easier.
Yeah. Because I haven't seen it, and I look at, and you probably see that whenever I'm asking a lot of the questions, I look at it from a value proposition for ETH. I mean, we inherit with or without any of the stuff out there. We have a yield that comes from ETH for participating, and that's why I've always said, the relationship, the social contract, as it were, that's out there is built into the code. Like, if I point this rig here, I get ETH. ETH happens to be worth money. Right, it's very linear in that perspective. Yes, there's a lot of politics, but so I start to try to focus on like, okay, value proposition for the users, the coders, the people that are actually, building on top of ETH. How does their functionality work? Because I have pretty good confidence in mining. Like, mining it's running Bitcoin. It's throughout a whole bunch of different cryptocurrencies out there. Like the mining stuff isn't all that difficult. Like you got to work, and it's just when certain things are toyed with that obviously we get all fired up on. But like that part, I'm pretty confident in. I mean, but yeah, it's just not. I'm not as confident on like the really hard stuff. And I mean, I'll point to you on other networks like Avalanche just launched recently. I know Sergey, or I can't pronounce his name. Was very, very outspoken about like how awesome it's going to be and all this stuff. And they had an issue, right? And it locked up. And hey, you know what? I've been in software development for years. It happens. So I would never hold anybody accountable for like things happen in software. It's what's going to happen. But, Cardano, I still have never got a wallet working right on it. There's a whole bunch of things out there that people have problems with. It's not, I don't necessarily talk bad about their thing or their product. It's just like, it's hard stuff. And like the mining stuff to me is a little more easier, more linear. Yeah. So it was just like, I didn't know how those other activities were going to work.
So it's actually relatively easy. For the transition to proof of stake, I will do I'm not, just going into this, I am not an expert on proof of stake or ETH2. I follow it along, and I know quite a bit about Ethereum, and so I can follow pretty well. But be prepared for someone to show up later on Twitter and be like, Micah was incorrect, and accept that, and it might be true. So just that fair warning. So you have blocks on Ethereum. You have a series of blocks. We'll just do 3 blocks here. Each block has some information in it. An important piece of information is what's called a state root. And it's one of the pieces of information. State root. So it's one of the pieces of information that's in every block. It's a single 32-byte number, so it's pretty small. And it represents a proof of the entire set of data that is stored on transaction. This is how most cryptocurrencies work, and I will avoid going into the cryptography of it or for now, but just know there's a 32-byte number that proves exactly what is in the entire, what the entirety of Ethereum basically says. And this, I'm hand waving a little bit here. It's a little more complicated than that, but that's basically the short of it. So if we go over to, and these are proof of work blocks, we'll say. So this is proof of work. Then at some point, we transition and we have our first proof of stake block. When this transition happens, the proof of stake block will point at the state root from the last proof of work block. And so we don't actually move any data. All we do is we copy that one number. So we have a 32-byte number that is a representation or cryptographic proof of this giant behemoth of 500 gigabytes of data, right? That's not a G. So we have this 500 gigabytes of data here that all of the mining pools or whoever making blocks and all the validators in the network need to store. And then we have 32 bytes of data that just proves that everybody agrees that 500 gigs is exactly the same. So all this 32-byte number does is make sure everybody agrees that the contents of this 500 gigabyte block of data that's on a hard drive somewhere is the same as what everybody else thinks it is. So when proof of stake transition happens, proof of stake will just copy that 32-byte number over. And so now they have the state root. And that state root will similarly point at that exact same piece of data. So there's no actual data copying happening here, except for the 32 bytes, and copying 32 bytes is pretty easy. Like we can do that in an atomic operation, atomic-ish operation. It's very simple. It's very simple, very fast, very, very easy. And that's basically the whole transition. So the transition is a proof of work miner mines the last proof of work block. In that proof of work block, there'll be a state root, which is a 32-byte number, along with some other stuff like the transactions that were included and receipts, blah, blah, blah. And then a proof of stake system, like the system as a whole, will say, oh, we just noticed the last proof of work block was mined. We are now going to copy over the state root. So now we are pointing at that big 500 gigabytes of data, just like they were. And now we're going to take over. Now we will start executing transactions. And then we go on to the next proof of stake block, et cetera. And again, this is ignoring the incentives here. This is like in the real world, you might have two blocks that look like the last block. And so you now need to decide, which one is pointed at. Is it this top one or is it the bottom one? And that's where things get challenging. Like, is it the red line that is the real, or is it this yellow line there that's the real one? So that's where things get complicated, is figuring out which is the real last proof of work block. And that's a hard problem. But I believe it is a solvable problem. The data migration, again, is very easy because we don't actually migrate the data. We just start pointing at the data from a different location. Does that answer your question a little bit there?
Yeah, I think it does. I mean, so I guess from my perspective that I was looking at is, like, anytime you have, let's take it from like the operations that can be done in the proof of work layer 1 protocol versus the operations and the new expansion of, sharding, ZK rollups, all the things that come in the layer 2 options that you have with POS. As it inherits that information back, it's like a foreign key, right? Essentially is what it's acting like, right?
Basically, this is the state where you can think of as a foreign key in a traditional database, where we're just saying, hey, here's a pointer to the data, and the data doesn't move. The data's still there. It's just something new. Something else is pointing at it now. One minor clarification on what you said, just to make sure there's clarity here. This proof of stake transition only transitions the consensus model from proof of work to proof of stake. It does not introduce sharding yet. Sharding is coming sometime after that. So proof of stake, people are talking about, 1 or 2 years, whatever they're saying. I don't need to keep track anymore. What they're talking about is this simple transition right here that we're looking at in this picture. That's it. There is no sharding introduction. There's no rule changes in Ethereum. It's only the bare minimum required to make this transition from proof of work to proof of stake happen. Sharding is a whole other can of worms that I know almost nothing about, because it is above my pay grade, so to speak. But that's sometime later, sometime after.
Okay, yeah, that helps. I was looking at how it would reconcile certain things like that. When I get the connection, you're just inheriting it through essentially that state root, and then you can get to the old previous information. But as you start adding other features, if it's using some kind of smart contract that only has a limited set of opcodes, but now you want to upgrade it to the 2.0 version of that, how does it deal with history? Like, I haven't seen it. Like, I've tried to dig and I haven't seen a lot. And I think it's just not the specs are probably in some people's heads or on whiteboards somewhere. But I just haven't seen how that reconciles it. And the whole reason why you're probably why does this miner even care about this is just part of it's like that, it brings it to my decision point of me staking, right? I want to see how's this going to shake out in the long run, type of thing.
So I can definitely go into how EVM upgrades happen and how rule changes occur if you guys would like. It's a pretty big topic, so I'm going to give you fair warning. Let me know if you want me to talk about that. I can definitely discuss how it works on both ETH1 and it will work in ETH2. It's basically the same answer, but it is a big answer. Do you want that now, or would you rather talk about other things and come back to it?
I think we'll shelve it, because I mean, when we start getting into this kind of development stuff, it might be like paint drying for some folks. And as we start to get into the
target demographic is.
But yeah, no, I'll totally dork out sometime with us and have, maybe we'll get a couple folks on there to talk some depth on a few of the other areas where we have gaps, and have use the channel, use all of our collective channels to help communicate some of this messaging. Just because there's so many more people in this space now than there was. And I'm just trying to make sure that folks have an avenue that we can go back, because trying to explain some of this stuff, sometimes I found it over a long period of time that I just now have gotten to referring to certain videos. So I have a sub catalog of where we've covered this type of topic. And it's not to pawn off people, but literally, I mean, I don't know how the other channels folks have. I mean, I have about 25, I'm almost at 26,000 unread emails now. So from that support side of it, and when I was collectively taking a lot of the miners back in the day, with, it was CUDA Miner, CG Miner, all these different miner programs that were out there. Used to write up a multi-miner script, and just the support on that was extensive. So I mean, I've kind of learned to either write about it or talk about it here, and then be able to point people to the video to kind of like invest a little time if they want to understand it. So yeah, well, that will be its own little collective. What's the differences in the stack type of thing? I think would be a better video for it, because we're pushing right up against 2 hours, and I think it's been a good call. I hope that people have enjoyed it. I know I have learned quite a bit, actually, and it's helped validate some things that I would just call out as assumption of my reading. And part of the reason why I know I made a channel for that reason back in the day is I'd read things on forums. I would try to understand stuff, and I don't want to call it kind of a Cunningham law type of thing where people don't know what a Cunningham law is. It's like, if you state something wrong, the internet will fix it for you. Like, and say you're wrong. Here's why you're wrong. Sometimes it's a matter of just trying to explain it your best way, and then you'll get some clarity from other people that are maybe better experts on it. So I do appreciate you coming out and having that. Seth, I saw your hand up. Did you have a question real quick, buddy, before we? No problem. Well, cool, guys. I think we'll wrap this one up right at almost 2 hours. I think it was excellent. Mike, you did an amazing job and just explaining stuff to folks, and hopefully, other ETH core devs will see some of this too, and maybe we can get some of them on at some point. We're not scary people.
Hopefully,
we're trying to learn.
They'll
stuff.
show up to tell me. Hopefully, the core devs will watch the video, realize how wrong I was, and show up and correct me, like you said.
Yeah. Hey, you know what? It's okay. We sometimes things are made on assumptions. Sometimes things are made with our opinions of something. Because we're more political on one particular way or another. But I like hearing both sides of it to understand stuff. So I appreciate it. And I guess we'll wrap this
Carter,
up, at least on my stream.
I apologize, Carter and Micah. I did get one last question from my chat, and just hopefully this is not so just ballpark, just shoot from the hip here. The question, and I'm sure you hear this all the time, what is a realistic expectation for the mining community as far as preparing for proof of stake, preparing for a major sweeping change to mining in general?
So yes, this is a very common question for miners, and it makes sense. I mean, you guys want to know, do I spend $100,000 on rigs today? It's going to be obsolete in 6 months, or is it going to last me a few years? So it's a reasonable question. The answer is sadly not one that's terribly useful. The reason for that is there's a lot of factors involved. So we've got proof of stake, which the design is done. So it is no longer back when Ethereum started a long time ago, they said, we're going to make proof of stake. We're just going to launch with proof of work. Like, we're going to start with proof of work, just to bootstrap things, and then we're switching to proof of stake right away. The problem is they realized that designing proof of stake was harder than they thought. And so it required a lot of iteration, a lot of work. And so it kept getting pushed back because they had a bunch of problems they still needed to solve that were not solved. Proof of stake is now to the point where those problems are all solved. They just need to be engineered. And it's a pretty big difference, because solving problems that may not even have solutions is very hard and has an unbounded time. Like, it could take you 1 million years if the problem is literally unsolvable. We are past that point. So we now know how to do all these things. Like, we know the research is done. We know how to do it. We just have to put in the engineering work to, turn those design concepts into code, and then make sure that code is robust, make sure the code is tested, make sure the code doesn't have bugs, make sure everybody, like we like to have lots of clients that all implement the same thing. There's the same reason NASA and military do this, is they implement the same piece of software 3 times. So that way, if 2 of them agree and 1 of them disagree, you go with the 2. And so Ethereum has a similar design philosophy where you implement the same exact thing with 4 different teams, and they all implement it independently. Like, they talk to each other and coordinate, but they are totally independent teams. They have independent implementations, separate developers. And the idea is that it makes it much less likely to have bugs, because it's unlikely that all 4 people will introduce the same bug. Like they'll each introduce their own bugs, but they're not going to introduce the same bug. And so you can very quickly identify, oh, they disagree, we can fix that. But what that means is you have 4 times the engineering effort required. And it can happen in parallel. So from a time standpoint, it's not a huge deal, but it does mean you go at the speed of the slowest implementation. So even if Nethermind, who's their velocity is pretty high, they get things done quick. But Geth has a much bigger code base. It's been alive for a lot longer. It's got Cruft built up with it. Open Ethereum went through a transition last year between who's running the team, and so their team is a little slower these days because they have a whole new team of engineers that are still figuring things out and trying to fix things, mistakes of the past. And so the development speed is the slowest of those teams. And then now you have with proof of stake, you have 4 new clients. So you had on ETH1 or proof of work, we have 4 clients. And then with proof of stake, we add 4 more clients, which is Nimbus, Teku, Prism, and Lighthouse. And so now we have 8 clients total. And the 4 proof of stake teams are implementing one set of things. The Ethereum 1 teams are implementing a separate set of things. And they all need to implement in a way that coordinates. And then once the last of those 8 teams finishes the proof of stake work, then we're ready for the merge. Again, including testing and all that. So that all being said, so that's basically me couching this answer with a lot of uncertainty. Like it's very hard to be certain because I do not know how fast the slowest team is moving right now. Like I do not know how long it will take the slowest team to implement this stuff. And then on top of that, we have like the specs for this are being written right now. So the researchers developed a thing. Now they need to spec it out in a way that can be implemented by these 8 different teams. And so we also have that unknown. And again, I'm not writing the specs, so I don't know their progress or their speed. So to further complicate things, so I know I'm delaying giving you an answer here, but I'm going to keep going. To further complicate the situation, there's a thing that has been talked about, and I know it's an uncomfortable topic, but I'm a big fan of putting uncomfortable topics out in the room. If there is an attack on the Ethereum network, the set of changes that we want to happen for proof of stake can be narrowed down to a much smaller set so we can release it sooner. And so if we need to, we can rush things, we can cut some testing out, we can remove features, we can back out our original roadmap. So original roadmap is very conservative, very careful, very measured. We're making sure that we have all 8 teams on board. We're making sure that we've gotten months and months and months of testing. We roll it out in phases. We want to make sure that certain features are in place before we go live. But if there is an attack on a network by anyone, like if anyone attacks the network in a way that can be mitigated by proof of stake, then it is possible to cut a lot of that stuff. So we can say, okay, we're going to do half as much testing. We're going to cut out these features. It's kind of like when the building's on fire, you stop worrying about like whether your faucet is to code. You're focused on the fire that's right in front of you. You're focused on putting out the fire. You're not worried about following the normal rules. Like you're not worried about following normal procedures because everything is on fire. You need to fix it right now with the fastest thing. So I think realistically for that, like if we cut everything and pared down testing and we were willing to drop a couple of clients. So again, instead of having of those 8 clients, instead of like, we're going the slowest speed of them, we just say, if 2 of the client or if 4 of the clients get done, we're releasing. Like, again, we're cutting the slowest people, so that would help save us some time. Like if we do all these things, I think, 3 to 6 month timeline, if again, this is the buildings on fire sort of scenario, in 3 to 6 months, we could, hack something together and get a switch to proof of stake immediately. No one wants to do that. That is a horrible strategy. It is very dangerous. It is very risky. It means we're going to miss out on some features. It's going to increase our technical debt significantly. We're going to have to drop some clients. Like it's very bad. Like no one wants this whatsoever. Like this is a very much undesirable thing. But I want to bring it up just because it is a thing that exists and it is possible. Like if someone's actively running a 51% attack, censorship attack on Ethereum, that is considered a catastrophic failure. And the Ethereum devs are ready or willing to do what is necessary to mitigate a catastrophic failure. In the more ideal scenario where everybody gets along, things continue, personally, I tend to be very conservative in my time estimates compared to a lot of people. I would say 1 year is very optimistic in my opinion. Just again because I'm conservative. 2 years I think is realistic. But I can see it going as long as 3 years. Again, but if you're looking for planning your mining hardware profitability over long term, keep in mind, I'm a very conservative estimator on these things. So you should not bank on 3 years because, like I said, could be as long as 3 years. When I say could be as long as 3 years, I mean that is within, like, if it takes 3 more years, I would not be shocked. If it takes 1 year, I'd be like, oh, they did better than I thought, but it's within their own possibility. If they got it launched with all the features without cutting anything in 6 months, I'd be like, holy shit, what the hell just happened? That would surprise me significantly if they did a full launch in 6 months. 1 year, okay, they're impressive. They did better than I thought. 2 years, yeah, that's about on par with what I expect. 3 years, I'm like, a little longer than I thought, but it's reasonable. So again, very, very non-commitmental answer, but I want to be honest with you guys.
But you do bring up a good point though too, where it's like, what happens if you do see that attack vector and you're like, okay, code red, everybody on deck, we need to switch over to proof of stake right now. Let's say you launch it. How easy is it going to be for all the people who are building on Ethereum 1.0 at this point to migrate over?
So the hope is with the migration is that third-party developers should not need to do much. There will be some things they need to do, and specifically certain apps need to take certain actions. For the most part, though, things should migrate seamlessly. So all smart contracts will automatically just start running on proof of stake. That part's very easy. It's that picture I drew with the giant 500 gigabyte state root that you just move a pointer.
Mm-hmm.
That's where all the smart contracts exist. And sorry, my cat is screaming. So that 500 gigabytes where all the contracts exist, and they execute on the EVM, and the EVM is not changing the proof of stake transition. So there's no rule changes in terms of how they execute that will happen as part of that transition. So that part's pretty easy. There might be some integration issues, like with tools like MetaMask and wallets. So they might have to tweak a little thing here or there, but I believe the plan is to minimize what they have to do as much as possible. And ideally, and this might actually be achievable, ideally, they won't have to make any changes. So they will literally just keep doing what they were doing before. Most of the changes we want to be in the clients. So Nethermind, Geth, Open Ethereum, and Besu for the ETH1 clients, those ones will need some changes. And then for proof of stake clients, we have Lighthouse, Teku, Prism, and Nimbus that will, of course, need to be changed. And so ideally, if things go as we want, that's where all the change will be consolidated in those two pieces. The rest of the community can just they don't even need to know proof of stake transition happening if everything goes smoothly. But again, if we do that accelerated timeline, there's a huge amount of risk there. That is, it is very possible people will notice that proof of stake launched because the whole thing could crashing down. It's very dangerous. And again, I want to reiterate, no one wants that. No one wants to rush proof of stake at all.
That was an excellent, it was a little longer, but I knew the moment Seth asked that, I was like, yep, this is going to be a minute, but it was good. I think it's good to understand the kind of, just perspective that you're seeing. Obviously, this is all speculative, for anybody who's tracking there, especially if there's any CoinDesk reporters in there, take it with a grain of salt. It's not authoritative, not having Papa Vitalik telling you what's going on here. But I do appreciate that talk. I will kind of end it on a thing. There's a statement I've always had anytime I've had a manager position or a leadership position in work. You make sure the people that you hire, you pay enough to take the issue of money off the table. So always pay people with as much as you can, from a business standpoint, to where they can focus on the work. That's one thing I want to make sure is abundantly clear to the folks that start talking or thinking about, this is to really the ETH core devs, anybody in the, if it's AFAB from the investment side of, thinking that people get paid too much for mining. If we're talking about a conversation about this, if the issue's on the table and we're talking about, decreases in rewards, then there's an innate issue. I mean, we should never even it shouldn't even be a question, right? When considerations are coming forward and release in 1559, if it makes sense to put a squash of this issue by increasing a block reward by 1, it should be a no-brainer. Take the issue off the table. The little bit of scrutiny that they'll get from the investment community will be very easily subdued from the issue being squashed, right? And I'll end on that. And it's always worked out very well for me. If you take care of people, and you take that issue off the table, people focus on the work. So I'll end us on that one. Hopefully you guys enjoyed that stream. Micah, thanks again for coming on. And we'll see you guys on the next one. My stream's off. Then my stream's off now. So good stuff.
Appreciate it. Thanks for having me. I appreciate the opportunity.
Yep. Awesome. Cool. Yeah, I know, Micah, you killed it. It was good. I think there's a lot of good information. I'm gonna have some time. I'm gonna try to make some chapters on that because I have 2 hours to get people to, for the TRDLs.
All right, guys, thanks so much for hitting that subscribe button. Thank you so much for tuning in for the full chat. That was so great. Tell me, what did you learn from Micah about the proposal to include minor extracted value and some of the revelations about the early beta test of UU pool? What was your key takeaway? Let me know down in the comments section. Are you enjoying this ongoing series of conversations about EIP 1555 and the roundtable discussions with Bitsby Trippin and other miners in the community? Let me know what you want to see more of. Guys, as always, appreciate you watching all the way to the end. Thanks so much. You're the reason I make this media. I love your face. See you soon. Thank you so much for watching all the way to the end of the video. If you want to be notified of videos like this in the future, first off, click subscribe, press the bell icon. Additionally, you can sign up for the Mind Your Biz email newsletter. That'll give you exclusive access to certain freebies, notifications for deals within the cryptocurrency mining space, as well as some of our flash sales for merchandise, which you can buy with cryptocurrency. That's right. It's the only cryptocurrency merch that you can buy with cryptocurrency. We practice what we preach. As always, thank you so much for watching. You're the reason I make this media. I love your face, and I will see you in the next one.